Hey everyone, Eric here. In today's video, we are going to learn about the startup unit economics journey from idea to exit. This is going to be a three-part series. In today's video, we're going to learn about SaaS startups. In part 2, we'll learn about marketplaces. And in part 3, we will learn about e-commerce. Okay, let's get started. Okay, so let's talk about SaaS. So in today's lesson, we're going to cover the definition of unit economics, all of the metrics that feed into unit economics, how startups want their unit economics to evolve over time and why. And then we're going to dive into a case study where we look at two different SaaS startups, one which has unit economics which are improving over its life cycle and the other that has unit economics that are stagnating and deteriorating, and what that means for each company and the benchmarks they should be tracking around. Okay, so let's dive straight in. So unit economics, the basic concept is that they represent the marketing costs and lifetime profit associated with one individual customer. So it's kind of like an income statement for one individual customer. So the goal of any startup is that the unit economics improve over time so that they continuously have marketing costs that are staying the same or going down, and that their profit per customer is going up over time. The reason why is because if unit economics are getting worse over time, it implies that your business will get progressively less profitable as it grows. So, if your unit economics are deteriorating, then why would someone want to own your company at 10 times the size? Because then it would be a business that is trending with each incremental customer towards worse and worse profits, and effectively maybe zero profits or negative profits at some point. So the unit economics of each marginal customer should be better than the last. That means that your business's moat is improving over time and that your business will be more profitable the bigger it gets. So that's ultimately the goal here. So let's dive into all of the different subcomponents of unit economics. So in unit economics, you have CAC, which is your customer acquisition cost. This is the amount of money you spend in marketing to get one individual customer to buy for the very first time. So if you spend $100 in marketing and that gets you one customer, or if you spend $1,000 and that gets you 10 customers, then your average customer acquisition cost would be $1,000 divided by the 10 customers, which is $100 CAC. The average order value, that is how much a customer spends on average when they buy, but then they might buy many times over their lifetime. So that's just the value of one order. Then you have gross profit. So that is how much profit the company makes from the average order. So you take the revenue and you subtract the direct costs. So with a SaaS company, that's generally customer support, hosting, different things that go into making the product live, a lot of technology costs. But generally, SaaS companies have very high gross profit margins, between 60 and 80%. The customer lifetime value is how much gross profit a company makes from their relationship with one customer over their lifetime of orders. So a customer might buy once, and then the SaaS startup makes 80% profit on that revenue, but then they're on a subscription, so they might buy 15 times. So their customer lifetime value is 15 orders and the profit that the company derives from that. So the ratio that we really need to think about when we're thinking about unit economics and we're thinking about SaaS is the CAC to LTV ratio. This is how many multiples of gross profit does a company make compared to the marketing expenses to acquire one customer. So let me just explain that through an example so that it makes sense. So let's say we spend $100 on average to acquire one new customer. But then over a 3-year period, the average customer is an active customer of ours for 3 years. So we spend $100, and then over the next 3 years, we end up making $390 of gross profit from all of their orders throughout that 3-year period. So our LTV to CAC ratio is 390 divided by the $100 CAC. So it's 390 divided by $100 CAC. That's 3.9. So we put in $100 and we make back 390. So that's a good investment because we make 4 times basically the marketing that we invest in one customer. Or you could say your post-marketing LTV is 390 minus 100. So your actual profit per customer after marketing is $290. But either way, you can see that you're making profit on a customer. Okay, so let's dive into this case study. Okay, so let's talk about this SaaS company. We are going to paint two scenarios for the same company. One where the company is doing well, one where the company is doing poorly. It's a B2B SaaS company. It makes an email marketing software, and it's launching the MVP, which is the minimum viable product, at $99 per month. One quick thing, if you're finding this content valuable, please subscribe to my channel right now and like this video. Also, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. Okay, so scenario 1 is here, scenario 2 is here. So let's walk through the good scenario. So we have these different phases. We have the idea phase. So this is the vision for the company. Then we have the MVP. So this is the 1.0 reality of the first version of the product. Then we have early stage. So the MVP is first few customers. Idea phase is no customers, just an idea. Then what we're calling early stage, I'm saying around $10,000 to $500,000 of annual recurring revenue. So 10 to 500K. Then the growth phase is what I'm calling 500K to 10 million of ARR. So this would kind of put you in the Series A through, sort of maybe Series B phase. And then finally, we're talking about late stage, and this is as the company scales from 10 million ARR to 100 million ARR. And this is where a company could become worth more than $1 billion and have a chance to do an IPO or be acquired for a very high price. So, idea phase. So we're saying that the CAC in our idea is $300. We think we can convert customers for $300. The AOV eventually is going to be $179 per month. So that's the price. So I think we can just call this price and AOV. We can put that down below as well. And then gross profit. And then the gross profit here is the AOV times 80%. So we're saying that it's an 80% gross profit margin. Then we're saying the customer lifetime value, we think that the average customer will be a customer for 24 months. So 24 times our gross profit per month, which is 143, ends up being $3,437 of customer lifetime value. The LTV to CAC ratio is we make $3,400. We only spent $300 to acquire that customer. So we actually make 11 times our CAC. Our LTV to CAC ratio is 11. And I'm saying that a CAC target at a minimum should be 5 for a SaaS company, and 5 to 10 is ideal, and best-in-class companies can even have an LTV to CAC ratio more than 10. This puts our CAC payback. So what do I mean by CAC payback? I mean, once we spend the money on the customer, how many months does it take for us to generate enough gross profit to actually recover our CAC? So I'm saying that we make $143 a month of profit, but we spent $300 in marketing to acquire the customer. So it takes roughly 2.09 months to repay the $300 CAC. So sometime in the third month, we're basically get into the green on the customer's lifetime. And we're going to cover that here in the cohort once we get into the MVP phase. And the payback target, I'm saying you should be trying to pay back the CAC in 6 months or less. One quick thing, this payback target, this depends a lot on the fundraising market. In hotter fundraising markets, companies are willing to generally have a longer payback target because venture capitalists are more willing to do bigger investment rounds for companies to effectively finance those longer payback periods and higher CACs. And then in weaker fundraising markets, you generally want to shrink the payback target. You might not grow as quickly because you won't be paying as much for the CAC, but it'll be more profitable, slower growth. And so in a weaker market, these numbers might be a little bit lower. In a stronger market, they may be a little bit higher. Okay, so now let's talk about our MVP. So let's say we launch the product and we get our first 10 customers. That's how many customers we have. The CAC ends up being $300, and our AOV at the time is only $99, our price. So the gross profit in the beginning is only 60%, and the LTV, we're saying on average, we think customers will be customers of ours for about 6 months. So the LTV is about 356. So the LTV to CAC ratio is only around 1, but if it's over 1, it still means you'll make some amount of money on each customer. So an LTV to CAC target in the beginning, if you're over 1, just kind of on the first couple customers, that's a good sign, because you know that you can have further price increases and you'll be able to improve your customer retention. So this is a good kind of proof of concept. CAC payback, we're saying, is 5 months. So let's look at what do we mean by 5 months. So this over here is called a customer cohort. This is called cohort analysis. So for the MVP, we're saying that in month 1, customers pay $99. In month 2, they pay $99 plus another $99. So this is a cumulative revenue. By month 3, each customer has spent $297. By month 5, they've spent $495, and by month 6, they've spent $594. So the gross profit cumulatively is your customer lifetime value. So in month 1, we're saying this times 60%. So we've made $56 per customer. And by month 5, we're saying we've made $297 of cumulative gross profit per customer. So what we're really looking at here is the payback period and how it actually works. So we know that we spend $300 in month 1 to acquire the customer. And then in that very same month, we make $59 of profit. So our customer lifetime value post CAC is negative $241 because we spent $300, and so we're negative $300, and then you add the $59 to it. In the next month, you no longer have the CAC, because once you've acquired the customer, there's generally no more marketing costs that go into the relationship with your customer. So now we're generating more customer lifetime value. So you can see that it takes about 5 months to actually generate enough cumulative gross profit to pay back the CAC. And it's here in month 6 where we're in the green and we have positive $56 after CAC on the customer lifetime value. So when you see 5.05, that's what we mean, 5 months. And just in the beginning of the 6th month, we end up being in the green on our customer lifetime value versus our CAC. So payback target, it could be 1 year. In the beginning, like I said, you just want to have a positive LTV to CAC ratio. The higher, the better. If it can be 2 or 3, that's even better. So now let's say we're getting to the early stage. So now we're scaling. We have 96 customers, we're saying. The CAC has been stable. We're able to continue to acquire customers at the same CAC, but we've been able to increase the price from $99 to $129. And then we've been able to, with that price increase our gross profit margin to 80%. In addition, in the first couple customers, they were only on for 6 months because our product wasn't perfect, but now customers are sticking around for 12 months. So 12 times 103 is 1238 customer lifetime value. And so the LTV to CAC ratio is now 1238 divided by 300. So that's 4. And so I'm saying that in the early stage, if your LTV to CAC is sort of between 3 and 5, that's where you want to be as you're scaling, because that means you put in $300 of marketing and you make back over $1,200 of gross profit, and you can run a profitable company with those types of metrics. So in this scenario, the CAC payback target we're saying is 2.91. Again, this kind of depends. Early stage, the payback target, I might say more like 9 months. You don't want to be spending too long recovering your CAC in this stage. Now we're getting into the growth stage. So this is when we need to really start scaling up our business. So we're going from 96 customers to 2,360. So we're saying that our CAC stayed the same. We've now increased our price another $20, and now our customers, instead of staying on for 12 months, they're staying on for 15 months. So our LTV to CAC ratio has increased even more to 6. And so our LTV to CAC target we're saying is 5, and our payback target we're saying is sort of 9 months or less. And in this scenario, we're paying back the CAC in only 3 months. And finally, as we move towards the late stage and we increase the business another sort of 10 times, we're saying that the CAC is similar. Let's say we're getting a lot of referrals. We've started a big referral program. We're getting a lot of organic traffic. So we've been able to keep our CAC low, increase the price to the original 179 that was in our idea. That has allowed us to have $143 of gross profit per order, and we've extended the customer lifetime to an average of 18 months. So now we're at an LTV to CAC ratio of 8.6. And so in this phase, if you can have an LTV to CAC ratio of 5 to 10, then that's fantastic. And if you can pay back your CAC in 6 months or less, then that puts you in a really, really strong position. So you can see in this business, each marginal customer, so all the customers between 96 and 2300, we're making more money per customer. We're making 400, then we're making 1200, then we're making 1700, then we're making 2600. And so this paints a story where the bigger we get, the more money we'll make from each customer. So the end state of the business, even if this business here is doing, let's say, $50 million, we think that if this business does $1 billion, the LTV might be 5,000. And so we think that the end state of the business is going to be better than the current version of the business. And with a business with a lot of growth in front of it, that's the story that you need to believe for people to invest in the company or to be acquired by a larger company, that the business is going to be worth much more. So the suboptimal scenario is a business where the metrics aren't getting better fast enough over time. So in this scenario, we have the exact same pricing, but we're saying that in the MVP phase, the CAC is a little bit higher. It's $325. And so you can see that in this scenario, the CAC is flat. And in this scenario, the CAC is going up. So it's $325, $450, $650, and then it goes up to $850. And you see this with a lot of businesses, their CACs kind of skyrocket over time. And that means that there's an issue. You know, you can power through that, but if you aren't making more money on each customer, then your business will run out of money. So the price is the same, but you can see that we are forecasting much different customer lifetime values. So here you can see 267 versus 356. Here we're saying 1238, and so that is a 12-month customer lifetime versus a 6. And so our LTV to CAC ratio in the beginning is 0.8. So we can't even break even on one customer. So to try to scale your business when your LTV to CAC ratio is less than 1, scale it 10x your business, you're just going to have 10 times more problems. So if your LTV to CAC ratio is not, 1 or 2 or 3 in the beginning, you need to work with those 10 customers to dial in your unit economics, and do not scale your company because you're just going to have 10 times the problems that you have in the MVP phase at the early stage. And then once we get to the early stage, our LTV to CAC ratio has increased to about 1.4, but we are trying to get to the 5 to 10 range to be a really healthy SaaS company. And so 1.4 is not good, especially for B2B. So then we keep scaling the company. We get to 2,400 customers. Our CAC goes higher and higher. Now it's double to acquire every customer. And our customers, they are staying on for 9 months instead of 6. So our LTV is increasing, but you can see that our LTV to CAC ratio is barely increasing because the CAC is offsetting the increase in our LTV. And then finally, in this late stage scenario, let's say that somehow you got your company funded and you kept growing. Now our CAC is $850. Our LTV, we're keeping customers on for 14 months. And so we've gotten our LTV to CAC ratio to 2.4. But that is not a solid LTV to CAC ratio. You're making a little bit of money on each customer, but a small change in the LTV or a small change in the CAC can drive your company into the ground. And so in this scenario, you want to be more in the sort of 5 to 10 range. Now, one thing I want to say, these are general benchmarks. You want to be in the 5 to 10 range. The payback targets, these depend a lot on the company and the price. So I would pay more attention to kind of the LTV to CAC benchmarks than the payback targets. Every company will be different, but you do want to make sure that for SaaS companies, you are making many multiples of your CAC and you're making higher amounts of gross profit on each incremental customer over time. Okay, so I hope this gave you a great idea of how unit economics should evolve over the life cycle of a SaaS startup. I'll include a link in the description below once the next videos are live about the unit economics journey for marketplaces, and then a third video about e-commerce. Also, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. And if you found this content valuable, please like and subscribe. And as always, in the description below, you can download this Excel template completely for free. Thank you for watching, and I'll see you in the next video about marketplaces.